Hello everyone. Why is the stock market freaking out today with investors around the world watching as indices plummet and fear of global recession loom large? But what exactly is causing this market chaos? And what does it mean for you? In this video, we will explore the key factors driving the recent market downturn. How is the weaker than expected US job report influencing the global market? Why are the tech stocks suffering so much? And what impact is the Bank of Japan policy shift having on the broader financial landscape? Understanding these market trends is crucial, not just for the seasoned investor, but for anyone interested in the global economy. Let's dive in. The US stock market opened in the red in this morning after a rough finish last week, triggered by the weaker than expected job report. The Dow Jones Industrial Average is down more than 1,000 points, marking a 2.6 percentage decline. Tech stocks, including the Nasdaq and S&P 500, are experiencing even greater losses because of this. Let's talk about the job report impact. Last week, job report shows that employer added just 140,000 jobs in July, far below than the forecasted one, 185,000. The unemployment rate has also risen to 4.3%, up from 3.7% in January, while the 4.3% is still historical low. The increase in the concerning indicator suggesting that the economy might be heading towards a recession. Let's talk about the tech stock decline, particularly those reliant on AI, such as Apple and Nvidia, are among the hardest hit. The sell-off is a response to a several factors, including the weak job report and overnight decline in the Japan's Nifty, which plunged by 12%, the worst day since 1987 Black Monday. Critics argue that the Fed should have cut rates sooner, citing the weak job report as evidence, with the inflation still higher than the desired, though much lower than the last year ago. The Fed focus might shift more on towards the economical stability and employment only. Let's talk about the recession fears and Goldman Sachs predictions. One of the primary drivers of this decline is fear of recession in the USA. The indicators known as S recession indicators has surpassed 0.5 percentage mark, historically a reliable prediction of recession. Goldman Sachs has raised the probability of the US recession in the next 12 months from 15% to 25%. Impact of US market downturn driven by the poor job numbers and high unemployment rate has dampened the investor sentiment worldwide. The expectations of soft landing for the US economy is fading, contributing to the bearish outlook because of this particular results. Bank of Japan policy changes. Additionally, the Japan market is struggling following the Bank of Japan's decision to raise its benchmark interest rate. The policy shift has disrupted the carry trade strategy, where traders borrow in yen to invest in the higher yield asset. The increased borrowing costs are causing further instability in global market as well. Coming to the Middle East tensions, the tensions in the Middle East are also influencing the global market. Iran, Hamas, and Hezbollah have threatened retaliation against Israel, which could lead to the surging oil prices. Currently, oil prices are at 8-month lows, but any escalation could change these scenarios drastically. Coming back to the India earning report. Weak earning report for the June quarter have also played a role in the market decline as well. Major companies like HDFC, Tata, ICICI Bank, Maruti, and TCS have reported lower than expected growth, contributing to negative sentiment. In summary, the global market downturn is being driven by the combination of weaker than expected US job numbers, tech stock decline, policy changes in the Japan, and geopolitical tension in the Middle East. These are the key takeaways from the recent market volatility for investors, strategy, and risk management. In my opinion, the current market crash serves as a reminder that even in a strong bull market, corrections and pullbacks are normal part of the investment cycle. It is essential to maintain a long-term perspective and avoid emotional decisions based on the short-term market fluctuations. In this particular time period, you must focus on the risk management. Investors should review the portfolios and rebalance their asset allocations to ensure they are aligned with their risk tolerance and investment objectives. Now it's time for Fed to intervene. The market reactions to weaker than expected economy and employment data highlights the importance of monitoring economic indicators and adjusting investment strategies accordingly. Investor must stay informed about the key in economic metrics such as GDP growth, inflation, and employment rate to anticipate the potential market shift. The current market environment underscores the Federal Reserve's ability to influence the market sentiment through the money policy decisions. Investors should consider the implications of the rate cuts and other monetary tools on the market and economy. As per cryptocurrency volatility, the sharp decline in cryptocurrency prices, particularly Bitcoin, demonstrate the extreme volatility of this asset class. Investors should exercise cautions when considering cryptocurrency investment and be prepared for a significant price fluctuation at any time. Now it's time for you to diversification. The current market environment emphasizes the importance of diversification across the asset classes, sectors, and geographic to minimize exposure to any one particular market or sector. Now it's time for you as an investor to calm down your behavior, educate yourself, and research properly. The current market environment underscores the importance of ongoing education and research for the investors. Staying informed about the market trend, economic conditions, and investment strategies can help investor make more informed decisions and avoid costly mistakes. Always focus on long-term things. Investors should maintain a long-term focus and avoid making decisions based on the short-term market fluctuation. A well-diversified portfolio and the disciplined investment approach can help investor weather market volatility and achieve their long-term goals. If you found this analysis helpful, please subscribe to our channel and like this video for more update on the global financial trade. Thank you. Have a good day.